While this isn't something that you see every day, with over 30 years of data and 20 similar circumstances, it's clear that Wall Street's fear gauge is starting to rise and we have to talk as investors and traders together. But with the market coming into $1 trillion options expiration, why should we be paying attention to the weekly 20 moving average? Well, it's mean reversion, and in today's video, you'll find out this is the biggest zone where bulls and bears tend to fight it out during corrections. And with the gap fill tacked on top and zero DTE options and CTAs starting to accelerate across the board, there's a lot of money at stake. Dow Jones Transportation Average is falling like a rock. Bitcoin is teetering on a potential of a big collapse. And of course, everyone's favorite semiconductor markets are starting to feel the pain. So, opportunity or fear? Let's talk about stocks, commodities, and cryptos in the upcoming market, massive earnings season kickoff for big tech. Well, welcome back everyone to The Daily Show. My name's Tom and we've got a lot to discuss. Macro, data, lead indicators, and the hottest charts are just some of the things coming your way. And if it's your first time here and you want to understand more about how markets work, remember to subscribe and smash that like button. It was semiconductors down across the board over the last 24 hours. And leading into the Netflix earnings big tech kickoff, it's clear to see that we've now entered into that correction territory with the S&P 500 drawing down close to 5%. On top of this, there's been other markets that have really started to suffer, in particular, the small caps that are down now over 20.25%. But that doesn't tell the whole story. What about what's happening during each market move? Well, as it turns out, we tend to be opening in the morning on the upside, sucking in a lot of us, the retail traders, and selling off by the end of the day. And this tends to have a stat that leads with it, which means that volatility is still set to be quite big for the next month. But is it the end of these markets? Is it the beginning of something a little bit more hostile, similar to what happened during the global financial crisis? Well, some of the evidence is not stacking up that way. And in particular, what this is actually starting to tell us is that markets might be getting a little oversold on the smaller timeframes. And leading into one of the most important support levels, this will matter. Here we have S&P 500 issues, the 8-day average of issues closing lower than the opening price. Now, this is an interesting one because when we tend to see this level being hit, it can come with it a bounce. Notice here, notice here, notice most of the points on your chart right now. This is going to be a paramount defense by the bulls, and you would think that they're probably going to try to hold the 5,000 based on the huge amount of options that are sitting around this zone. If it does fail though, get ready for the potential of a flash crash, as hedgers will have to look towards protecting huge amounts of put positions on the smaller timeframes. What else is telling us that volatility is here to stay for a little while? Well, here we have the S&P 500 after the New York Stock Exchange advanced decline ratio exceeds a -4 to 1. So not a very good result, really, out of the last 4 sessions. Now, when we tend to see this, not many data points, but it does lead into a couple of weeks of vol increasing. So this means that the VIX, the fear gauge from the market, might actually get above that magical 20 zone and give opportunity for all of us as traders and investors to make money in these markets and potentially set some longer term investments if you know what you're doing. So which areas should we be watching? What should we be looking at in terms of the data? One of the best things to do is always to look at the advanced decline line and also to consider whether the volatility index is really incredibly fearful. Well, it doesn't seem to be incredibly fearful yet. 18.4, while it is high and it means that it gives us opportunity, it's not sitting at that kind of magical 25 plus zone, which tends to bring in the bigger sell-offs. And you can see they're kind of dictated to by the reds on these charts. Also, the advanced decline line has been generally rising throughout this recent bull rally, suggesting that there is a decent amount of breadth behind the markets and that there's a possibility that, of course, markets will still gain good percentage after this. When we have the VIX underneath 28.5 and the advanced decline line trend over the higher timeframes has been still on the rise, generally that means a pretty good gain for the S&P. If that changes anytime soon though, which we will update altogether, that's going to be when we need to be concerned, everyone. So what about the rest of the breadth stats? Here are some great ones here from Grant Hawkridge, and you can see that the percentage of S&P 500 stocks below their 200-day average or 50-day average still remains quite low, which of course it makes sense. We haven't really pulled back very much yet. Also, this one here is on the rise, which needs to be watched. And in general, a lot of markets are starting to show that kind of oversold statistic on the smaller timeframes. So you can see here that new lows breadth dashboard is across the board red, with pretty much every sector other than some of the materials, some of the metals, some of the gold stocks being down. And luckily, we've all been really following gold stocks and the materials and metals recently, so it hasn't been so bad. Here's another way of representing the same types of breadth. And you'll notice here that the opportunities for a longer term investor may actually be in the mid and small caps. Take a look at the percentage of 3-month lows. In our previous video, we were only seeing around 19% of these stocks in their 3-month lows. That changed over the last 24 hours to 25.6 as the chance of higher for longer becomes a real thing. And some investment houses, if you can believe it, are now saying no rate cut until March of 2025. Higher for longer means earnings season is so important. If these stocks do not live up to the expectations that the street has set, then we could be looking at a more sizable downturn. And here are the stats actually for election years. Now, I know we've all come to believe that election years are glorious bull runs that are all fantastic, but did you know that actually election years do come with some pretty decent pullbacks during the year? And that's not to say that we don't end in the positive by the end of the year. That's actually a pretty normal thing. But the average pullback here over a lot of data tends to be around 13.07. Now, that's a pretty big pullback when you consider market averages. And right now, at the time of recording, we're basically sitting at around 5%. So could we get a negative 10% on these markets? It is possible, but I do think that this could be where the markets start to find a little bit of bounce on the smaller timeframes. Here's another way of looking at it when you cut everything that's happened so far leading into this month of April. And this is from Wayne Whaley over on X. And you can see that Wayne's come through with a pretty bullish stat, which basically shows that if you had a really strong start to the year, you had the lead up that we've had, in similar circumstances, you tended to actually come out incredibly positively. So it is still a good time for the investor, potentially even the swing trader, to still have a bullish tinge on this market, even though it's selling off and things are starting to get a little weird. And there are some zones that we'll look at on the S&P 500 charts that I think present very good technical range levels to see whether the markets actually find those bull pressures. Does it make sense to, when we overlay all the correlated markets over history and how they've performed this year, that this could occur? Well, yeah, realistically, if we have a 0.93 correlation, and in most of those markets, we tend to get a lot of chop, we get a lot of volatility, we get a lot of increased madness around this point in time, but then come out the long end pretty well. Well, that means that it's kind of starting to connect all the dots. And you'll see some further data later on today's video. If it's your first time here, I have been bringing this up a lot, that suggested that we would see this volatility, or at least some kind of correction style thing going on at around this time. We also know that other stats are starting to say that we're a little bit oversold on the smaller time frame. Here is the S&P 500 percentage of stocks above the 50-day moving average, and that's absolutely dropped like a rock in the recent sales trades, leading all the way into these areas. And again, this is kind of signaling that we might be in for a little bit of a bounce. Now, whether we make a new low or not, that's possible. And the next level will be something like the 50-week moving average, which we'll look at in a moment. But yeah, I do see some defense coming in from the street over the next couple of sessions. So let's have a look at why that might be. Firstly, the gap that everyone has on their charts. Now, what a gap is it's basically where the market is closed at a certain price and opened at a different price. And in this case, this is probably the most epic gap that we've seen in quite some time. It was a huge one. It happened in futures, happened over the weekend, and it led to the market basically going dull and grinding higher. And then, of course, now we're at where we'd expect to be. Now, this isn't just any normal gap. It's a gap that sits also on the weekly 20 moving average. Now, if you know anything about your weekly 20 moving average, you would be aware that this is one of the most epic indicators on the markets. And the reason is quite simple. It is the mean reversion, often used by the street, often used in reports when you read them from some of the bigger houses. And I think, look, the evidence for the longer term investor is pretty solid when you consider 2020 kind of rebounds and other periods. If you believe you're in a bullish breadth market, this can be an interesting zone. But it doesn't just stop there. There's also a 50 moving average. So if we change this chart to the 50 just for a moment here, and generally I like to make it blue. Hey, don't get me, I don't know why, but I love that one and I always set it this way. And you'll notice that there are a lot of hits to the 50s as well. These three basically moving averages, the 20, the 50, and the 200, tend to be some of the best zones for the investor when it comes to markets. And I do love going through history, and you'll notice in these high breadth style markets, the corrections sometimes pull back down to these zones. Now, where does the 50 find ourselves? And I think this is a very interesting point. Notice it's this structure over here, the 4,700 to 4,800 period. Now, this would be a massive stack because, of course, if the markets were able to get through this zone, let's say doing something like this, that would be in the vicinity of a normal correction period. In fact, this would be over the 5%, which is where we're at right now, and sending down to around 10. Now, if you remember in that other stat, we found that that was kind of like the average if we do get a pullback during these election years. And it would also make sense to some Fibonacci levels as well, sitting at around the 50% fib in here. Now, is it perfectly healthy to get these types of pullbacks? The answer is yes, it is very normal. And you might say, well, behind the scenes, people are starting to worry about higher for longer. Well, higher for longer really means that the overall market is still expanding and growing, which could be still good for some of the biggest mag stocks. It basically means that there's some type of growth there. I would say it's all on earnings season. How does Netflix go over the next 24 hours? How does Tesla go? How do the Mag 5 stocks go in particular, the ones that are carrying this market on their shoulders? If they fail or semiconductors start to show weakness, get ready for a bloodbath on markets because they are solely reliant right now on those earnings, and that is going to be the biggest storyline. Let's have a look at the futures market, though, to start to understand a little bit better how this market's been trading. So you'll notice that we had kind of like some chop coming through, and the chop sold in to around the 5,000 level. Now, it's not quite the gap fill, but this is a very important zone. And there's going to be a couple of levels that I think need to be looked at very closely over the next 24 hours. The first one is going to be down here, 4,980 to 5,000. We know that coming into Friday, this should be a defended zone based on options that we'll look at in a moment. It also just turns out that around 5,000 level is also a massive amount of options for Thursday and Friday, suggesting that on the 0 DTEs, if this level can hold, the street would make quite a lot of money. Now, if it does push through and end up closing below, get ready again for significant weakness because we're in what we call a negative gamma environment, which is going to need hedging of these positions. Now, where are the supply zones? Where are the bears potentially sitting? Well, we already saw a bounce once to this level, and it's unfortunate because this would have been a sweet short zone of around 50, 57, the most traded level throughout this structure. For the bulls, what are you looking at regaining? Around 50.80. If you manage to get through 50.80, that actually could be all we get in terms of sell-off. It's possible. 5% corrections are about normal in these types of markets. So you've got to be very on top of that 50.80 level. But I think the next maybe 48 hours will matter quite a lot. And I've put in here some of the most traded zones. So from the top end side, this is all possibly areas where you could see the sellers come back in. And if you get through something like that, I think we're probably squeezing higher and that would be all we get. So there's a lot at stake and this is the key zone to be watching. Let's have a look at the options and break that down. So the 50, 20, 5,000 level is struck incredibly strongly for Thursday and also for the OPEX. Now this one's a lot bigger than the others. Of course, there's a huge amount of options expiration here. And you would think that they would try to hold it around this zone. Now, what happens after this OPEX could be on the charts because that will be where we start to get maybe still a negative gamma situation, maybe when we switch from a negative to a positive gamma situation, but we'll be updating you whatever happens here. For now, 5K is the line in the sand. A huge amount of puts, a closure below, that's going to need a lot of hedging. So yeah, I'd be paying a lot of attention to the 5,000 level. And on the top end, we're looking around that 51.50 still for a bit of a switch to the upside. Do the CTAs tell us that it's a good time to buy? Well, we know commodity trade advisors have been early to the game several times now, and they've shown us usually when weakness is coming through. We've reported on this quite a few times on the channel. So if it's your first time here, definitely sub for this because this type of data, it's a little bit of edge. Edge is good. And we love to, of course, track it. You'll notice here they're still dumping at a pretty accelerated rate. So this is the real deal in terms of CTAs dumping across the board. And they're bringing the markets maybe back into harmony, back into that flatlining level. Same thing for the NASDAQ, similar type of situation to what we saw last year, which ended up in a bigger correction of that 10% parameter. And that could be, again, where we're at. So CTAs are going to matter. We'll need to keep tracking them and pay attention to it. We'll also need to update some sentiment composites, such as this one here from Grant Hawkridge, because as you'll notice, we were in that kind of risky end. If we get into this kind of opportunity end, then that again shows as investors and traders and everybody else that we'll be wanting to pay a lot of attention to the upside and possibly go into, further bull runs in this market. What's going to be the linchpin? Well, I think it's Netflix. Netflix is coming out over the next 24 hours after the close, and it's expected to be a plus minus 9% move by the markets. So this is no joke. It's going to be very volatile. And I think this earnings season, as you'll see with one of the stocks that we're looking at a little bit later on today's video, is going to be a bonanza for day traders and swing traders, because there's going to be so many opportunities coming out from stocks meeting and missing expectations. In particular, the miss side. I could see some brutal sells in the vicinity of 20+% on some of these stocks that have been maybe overvalued at the moment in terms of multiples. Remember, if they don't live up to expectations, things get weird. Election years, what tends to happen, you'll notice some are bad, some are good, but in general, we're kind of tracking some of the ones that tend to be pretty good, and the pullbacks are met by bull demand. So you've got to remember, it still pays to probably be a bull on these pullbacks. You may not agree with that, but some of the data, some of the breadth suggests, and look, that's really what we're looking at here, suggests that this market is in for more run-ups. Now, this is where we are in terms of a secular bull market overlay, about 2/3 of the way through. We're also at a point where you'd usually get pullbacks into strength, and it makes quite a lot of sense on these markets. Here's another one that I think is brought up a lot. A lot of people talking about equity risk premium. Now, I'm a big believer of equity risk premium when you're thinking about protecting your money overall, but when you actually invert it, you'll notice that, and you go back through the history, there were times where ERP was way worse. So is ERP bad? Yeah, it's way worse than it was over the last decade, but it's nowhere near as bad as it has been. In particular, the run up to things like the 2000 booms. I think markets can get even more overpriced before they potentially, really fizzle out. So that's going to be, one of the big stories here. What about the last 24 hours? Well, some of the defensives held up. So of course you had all your normal subjects. You've got over the last 5 days, utilities, staples, metals, healthcare, gold. This section I particularly liked. Of course, utilities in particular, we were following for a little while, although I'm done with those for now. But it was really anything to do with high yields for longer that's suffering. The small caps really are not doing well in these markets. What about the last 24 hours? Well, again, it was a pickup in utilities, a pickup in gold, and surprisingly, we saw a pickup in some of the overall stocks here, including TAN, but semiconductors were down big, 3% down, starting to give up some of their multiple gains. And that's probably leading into the overall earnings season, because people are saying, well, are they going to keep up their multiples? There'll be some storylines, but really I think it's about earnings. 18.22 on the VIX as we get into the charts. That's pretty volatile, but not above 20. When we take a look at the bonds and we look at the options level, yeah, that's starting to accelerate, again, showing us the corrective kind of nature of this move. We've had previous periods where we've got this kind of blowout. And of course, this was one of the things that dinged on our list around 2 weeks ago, showing us that we had to have extreme caution into this current market. And so far, that's been how it is. What about US 10-year? Well, that's actually dropping off a little bit after the recent sell. And you'll notice here that bonds continue, in particular, junk bonds, continue to be weak. So even as yields came down, bonds were still selling off, showing that it is still a risk-off market for now. There are a couple of other things that I've been looking at, in particular, treasuries. So you'll notice here treasuries are back at the golden fib ratio. This is an area where I think treasuries buyers should be kind of interested back into treasuries. And I don't think it's a trade. I've always said that. But from the perspective of getting back down to a 61.8, everyone now hating the treasuries trade and it being at an important zone, I think it kind of has found that zone or that area. We've also seen home builders dropping like a rock. This marks 1, 2, and 3 weeks. Now, we're not quite at where I would think that home builders could get to. Somewhere around that 95 level seems to make sense for me. And it suggests that if we do get a bounce, there's still a chance of making it back down into these zones later on. Home builders have been phenomenal investments over the last kind of year or 6 months, 60.2% on the upside. So home builders really giving up a little bit. Another one's been Dow Jones Transportation Average, which you'll notice here was dropping really hard over the last 24 hours, and volume was up big time. Now, when this drops, you do need to be paying attention. It generally means there's a weakness in the market. We obviously used it last year to kind of signify turning points that were more significant, and of course freak out points, and it is one that you should be watching. Dow Jones Transportation Average certainly weakening there. What about the US dollar? Well, I think this is going to find a little bit of troubles here. This is a previous level of supply, we know, or resistance, whatever you want to call it. And basically the structure here is causing this market to probably consolidate. So I think the dollar trades, the easy dollar trade up to here is probably over for now. And we're either looking for a 107 breakout to bring the Super Bowl, or some type of better alert here to show us that the market's going to be moving up or down. Copper still holding very strong. 4.4 is an alert I would have on the charts. We are bullish on copper over the next 6 to 18 months, and it is holding up. Gold, barely holding on. So we like gold. Don't get me wrong, I really like gold, and I love gold stocks, which we've been talking about a lot. It is still holding this trend line. I've already told you I think it's in exhaustion. That doesn't mean I'm going to go sell gold. The trend is up. The market has been strong. I think the risky trade is really to go for the sell on it. If you were going for the long, you'd generally be better. But you'll notice here that this is still a lower high than over here, which is a high, and it's putting pressure on the trend line again. That's never a great sign to me. And while I did like it here for a little bull scalp, I think it's be nimble, be fast in gold at the moment. If you've got a longer term opinion on it though, it might keep holding up. But yeah, very, very kind of overbought market. You'll notice here I've got a red stop sign. When I tend to get these types of exhaustion reads, it usually means a pullback in time or a pullback is due for that particular thing. Now, this is the one that I think we did some Inspector Clouseau on. This was certainly one that was looking much weaker over the last 24 hours. We talked about this level not holding, and the reason why was because we held a close here every time. Then we started to make a series of lower highs. And again, price action showed us that something was weird with the oil trade. That eventuated and it sold big time. And I think that the storyline coming into this week would have been buy oil, geopolitical, all this type of stuff. Just remember, on the left-hand side, what did it do? It went up massively. Energy stocks were up like 30%. So they were already up leading into this. So now that it becomes kind of like buy the rumor, sell the fact, retail traders are unfortunately probably getting hit by the energy trade. Now, that's not to say that energy stocks are going to absolutely get destroyed. It's all going back down. But this is probably the breather that oil needed to have. A few things have happened. It's broken through its daily 20 moving average, signaling the first time of weakness throughout this run so far that we've been on together. And another thing is that we probably need a little fall further. So I'm thinking somewhere between 81 and 81.90 is the next stop for oil. I don't really like this level too much. So I think that pullbacks will be met by bear demand at this point. And oil looks to be set to maybe find some weakness. The real tip off here was pretty much this. And although I still had a buy in here towards it, it just ended up being a break even. So the reason why is because, trend was up. But even in that case, the market moved enough up to get you a break even if you knew what you were doing. Another market that looks pretty weak has been Tesla. Now, I'm not loving this until it gets below 152.42, and then we see what type of reaction it has there. As we often say, patience, react, don't predict, and I'm kind of really going with that mantra here. Tesla's in a lot of trouble. Obviously, earnings coming out next week. I think there'll be a reaction off that earnings that's going to be a really great trade. So we'll be watching this one very closely. Apple comes in closing on the low. Not a great sign. Now, traditionally, this would not be a level that I would strongly buy. The reason is because it's closed on the low. We need to see more information. You don't have to trade Apple just because it's there. You have to trade the stocks or the positions that you believe you have statistical edge on at those particular times. So in this case, it's closed on the low. Not great. Let's find out how that weekly ends up. And of course, Netflix ends up trading. So speaking of Netflix, let's pop it in the chart here. And you'll notice it's just coiling around. So even during this market sell, Netflix doesn't want to move. Why? Earnings. And I think it's going to be explosive. Plus and minus 9%. Plus, of course, would give you that acceleration momentum and possibly push the market to the upside. And negative would push you down to at least, you would think, 550 to fill this gap. And that ends up being around -9% from current price. So it really just shows you the options market's really setting up for a big move. Semiconductors, quite weak. Now, when the strongest market sector for a long time starts to weaken off, goes through the daily 20, you do want to pay attention to it. If we go to the weekly, you'll notice it's nowhere near mean reversion yet, which is 201. And again, it kind of suggests that even if we do get pullbacks here, there is that real chance of a 47, 48 for the S&P. I can see why a lot of people believe it's real. I'll be following the price action more than anything else, but you can see why, because semiconductors would need to return back to this weekly 20 moving average, which just so happens to be previous demand. And there's quite a lot of different techniques that are sitting there from a technical basis. When we have a look at Lululemon, I want to bring this one up here. This is the type of thing I think might happen this earnings season. A monstrous capitulation, even though supposedly good earnings, probably bad forecast. I didn't look into it. But the point is it's a capitulation trade. And I mentioned this in our Market Masters Club, free 7-day trial, link in the description down below if you want to take a look at. This is probably my favorite upside position of the last 24 hours. Now you might say, well, Tom, that sucks. It's only up 1.73%. Yeah, but the rest of the market was down, guys. It's still up decently. Now, this is the type of thing where the market becomes a little bit oversold. And you need to know what you're doing in these circumstances. But I do think there'll be quite a lot of these when you know what you're doing and you're paying attention to it properly, positions this earnings season. Let's move over to NVIDIA, pressing down on the 830, 840 zone. Now, I've got a little bit of a special here because I thought we should look at options. Look at the pressure to the downside, the daily closing on the low. Semis really did get hit. And while they may find some bouncing pressure around here, if they do weaken, next stop for NVIDIA would be around that 780 zone. Now, let's look at the options and show you why. First up, this week's OPEX, the 19th of April. It is stacked around here with puts. So if the market does end up closing below this level, at the moment you would think the puts are going to be defended to make Wall Street more money. But if it does end up closing below these points, there's going to need to be a lot of hedging. But have a look next time around on the 26th. There's almost nothing next week sitting there in comparison. So the chances are that we actually could see a little bit of buying pressure, or at least sitting here. And if we did end up going through, it could create a capitulation sell. So again, earnings season's going to matter. I expect there be a lot more options on NVIDIA coming into the weekend video that we'll do. So we'll be paying attention, but you'll notice that this is why there may be some buying pressure around this point for NVIDIA. I don't think with a daily closure on the low, it's worth having a go at, but that's where you're at. And that's the evidence that we have in hand. As we expected, the Aussie market is holding a little bit better. So we'll go into major indices here, thanks in part to metals, banks, and of course, energy and some defensive components. Same thing with the FTSE, I'm sure. Basically, this level here is just the defended zone of the bulls. So you'll notice that it's kind of trying to find that buy area. HSI, the Chinese market's doing its own thing again. It's bouncing through this zone after going through here, finding the support on the secondary level. Still bullish on the Chinese market, and obviously nice to see it kind of picking up after what has been a big sell. Now we move over to the German DAX. It's been a little while, but I thought this is a key zone to look at. We got this weakness here on this massive candle that we saw on Monday. That was a really bad sign. Great next day short. Then we get another weakness candle here, which signified pressure onto the first bull zone, which I've marked out. What if we get a higher high here? Could that be the end of the selling, or at least a decent rally up? I think that's a good zone. Of course, a break underneath this level would probably mean that we're breaking below the weekly 20 moving average on the S&P, and of course pressing down on the NASDAQ as well. And that's going to create, there's almost nothing sitting here on the left-hand side. So the chance of a real sell under this becomes way more real. It is a super defended zone by the street across the board. US 2000, I find this one a little bit harder to read. It's reached our level, which is, of course, 1950. So I can see why a bull might try to press this. Notice the markets have all done this in synergy. NVIDIA's hit that key zone. S&P 500's hit into the weekly 20 moving average. Then we've got so many stocks sitting at these critical levels, and they're all happening ahead of the Netflix data. NASDAQ, also another one, fell off last 24 hours, went down to 17.5. Yeah, it's like a minor support zone. The bigger one would be 17,150, but it's not there right now. So again, this type of thing is very possible. I don't think there's an easy trade on the NASDAQ myself. Let's move over to crypto now. Ethereum, bull zone number 1, still coming down with pressure. This is certainly the level. If something happens though and Bitcoin falls through, get ready for bull zone number 2, because I think that would be pretty bad for crypto. And speaking of Bitcoin, hey, it performed almost a minor miracle to really pressure itself down here and find buyers. Now, I've said for a while that I think holding 63 was a big area and that bears would probably push through here. I mean, obviously the level is 60, but I do think this is still quite negative towards the market. We'll have to find out whether we can break any of these zones for swing traders. You have to remain flexible. I could see why someone would try to buy here for a dollar cost average or whatever they're doing in Bitcoin. But if it does end up falling through and closing, of course, this level, because there's really no shelf on the left-hand side. So a big zone for 60,000 and 60,008. It did have a reaction. The reaction so far has been less than last time, showing less bullish intent. I am super keen to be following the crypto markets right now. I think there's great volatility here, and we're just continuing to make those series of lower highs and lower lows. And as long as that sequence is maintained, really the bears are in control of the smaller timeframes. What if we get through, this level here of 64.5? Well, then we can start talking about the bull side again. So I want to say thanks so much for watching the video. If you enjoyed it so far, remember to subscribe and smash that alert button. And we'll be covering markets every single day of the week. So remember, it's always good to educate yourself on how to better understand how all these markets move together. And at this point, the signs are looking towards a massive fight at exactly this zone. Good luck out there, and place a comment down below with what you're looking at buying next. Bye for now.